Good afternoon, everybody, and thank you for joining us today for our discussion, which we've called Venture Capital and Impact Investing, Changing the World One Idea at a Time. I'm Jamie Broderick, and I'm a director at the Impact Investing Institute. My professional background is as a business head at UBS Wealth Management and JP Morgan Asset Management Europe. I'm really pleased to welcome to the discussion three people that have immersed themselves in the challenge of getting capital to startups that are solving important problems, and often in ways that the business world has not seen before. They are Gary Stewart, Chief Executive and co-founder of The Nest, Jean de Fougerolles, Managing Partner of Ascension Ventures, and Chris Wiles, who is a Senior Investment Manager at Foresight Group. We're going to start with a discussion with our panelists, then we'll move to your questions, which is one of the best parts of these discussions. So please type directly in the Q&A feature, which you should see at the bottom of your Zoom window. And even if you don't have questions of your own, take a look at the Q&A box because you can upvote other people's questions. Let's start by having each of the panelists give a brief description of themselves and their organizations. Gary, can we start with you?
Yeah, sure. So thanks for having me here, first of all. I'll do my 1-minute pitch, which I've practiced. Born in Jamaica, grew up in the Bronx, went to Yale College, Yale Law School. Didn't know what entrepreneurship was when I was an undergrad. Discovered it somewhere in Europe when I was at a corporate law firm, and discovered that I actually found the work to be pretty boring. And that I kind of wanted to do something else. And then I created a company in Spain back in 2005. Eventually sold a company after raising some capital for it. It was nothing related to impact. It was a property search engine. And then along the way, kind of got into working with Telefonica, which is a very large, I guess, telco, helping them to set up an accelerator, one of which, or various accelerators actually, one of which was an impact accelerator called Wire Unlimited, which was a joint venture with the Cabinet Office. Then eventually got more into impact, kind of working with Jean eventually on the Fair by Design Fund. And now I have a company called The Nest, which is all about leveling the playing field for entrepreneurs around the world to make sure that everyone who is currently overlooked also feels that he or she can potentially have a chance in entrepreneurship.
That's great, Gary. Can you just elaborate a little bit on what The Nest is, how it's doing that, how it's approaching underrepresented founders?
Yeah, so I mean, I think that when you look at the numbers, it's something like, I look at the US because it's where you have the demographics kind of the most clear. But like, I think it's something like women and minorities represent 70% of the population, but probably only get about 3% of venture capital funding. And so usually people say, well, there's a pipeline issue, but it can't be that 70% of the population can't come up with good ideas, and that it's only kind of a very small percentage that has all of the really wonderful ideas. So what The Nest does is, one, tries to unlock kind of the language of entrepreneurship, which sometimes serves as a kind of jargony kind of blocker. All the stuff about customer acquisition costs and stuff like that. It's how much does it cost to get a customer? How long can you keep them? Can we use a simple language? So can we demystify the language by having really wonderful and successful, diverse entrepreneurs explain exactly what is really going on, to focus on people who actually have been there and done that, because I think that when you look at Silicon Valley, that's really the secret sauce. People who actually have scaled businesses as opposed to people who've written and thought about it. And then I think the second bit is to kind of unlock the social networks that are really required for the warm intros that ultimately lead to financing. Because at the end of the day, I think another interesting statistic is that 40% of all VCs in the US went to Harvard or Stanford. And therefore, if you went to Harvard or Stanford, you're much more likely to get funded than if you went to even Yale. Much less, without even speaking about if you didn't go to college at all. So I think that those are the sorts of things that The Nest tries to do, all through a digital platform, all in a scalable way, focusing on the 99% of the population that currently is forgotten about in entrepreneurship.
That's great. Thanks, Gary. Thanks for that. Chris, let's go to you.
Sure. So I'm Chris Wiles. I'm currently a senior investment manager at Foresight Group. I work specifically on the Foresight Williams Technology Fund, which is a partnership with Williams Advanced Engineering. So we invest in early stage, pre-Series A, Series A, deep technology companies, which have usually a hardware angle, but also some software. Prior to joining Foresight, I was at Centrica, and I managed their Ignite Impact, Social Impact Fund, which was a £10 million fund run between 2013 and 2018. We made 19 investments into early stage companies in the UK in the energy sector, which had a social impact in what they did and how they did it. That fund ultimately got consumed into Centric Innovations, which became a larger £100 million innovation fund. But I've been delighted to join the panel today, and it's been great kind of going back and looking at some of the work we did at Centrica and some of the frameworks we use to help articulate impact. And it's made me realize that we can always be doing more to improve the impact that we're having in our day-to-day work.
That's great. Thanks, Chris. And it's interesting that you with Centrica and then Gary with Telefonica both had an experience with corporate venture, and I hope maybe we can come back to that. Jean.
Sure.
Jean, you're still on mute.
Yeah, sorry. I'm Jean de Fougerolles. I'm replacing Emma Steele, who's not feeling well today. So I'm the founding partner of Ascension Ventures. We are an early stage VC that invests in impact and seed tech businesses. I'm currently sitting in the Wire offices, Telefonica's accelerator, where we are investors in residence. We've invested in 112 companies in the last 5 years. We've got currently 3 different funds. We've got kind of SEIS, EIS funds, which invest in early stage tech businesses. And then we've got 2 impact funds, one called the Fair by Design Fund, which is looking at reducing the poverty premium. And we've got the Good Food Fund, which is looking at tackling childhood obesity. So some of our funds, don't have a thesis, some of them do, but even the ones that don't have a thesis, we're always attracted to tech for good businesses.
That's great. Thanks, Sean. Now, since there might be people in the audience who come more from the impact side than from the venture side, and because I myself am new to the world of venture capital, having done 30 years of servitude in the listed markets, I'm just going to start with a description of venture capital. You guys can comment on it or disagree if you like, but let me just describe it as, so venture capital is a subset of private equity. It's a type of financing that investors provide to startup companies and small businesses that have good long-term growth potential. It's riskier, or it's considered riskier than other forms of private equity investing, because startups are less established than the more mature companies. And a typical venture portfolio will include startups that don't make it, offset by other companies that can earn investors a multiple of their money. I'm looking for nods from Chris, Gary, and Sean to see if I got that more or less right. But I think it's useful to, there's a little bit of mystery around venture. It's a very exciting area, but I think if we could start with that. If you guys want to disagree, you go right ahead as soon as you get the floor. But let me start. My first question is actually an observation, which is that Big Society Capital released a report today that says that impact investing has grown from 830 million pounds in 2011 to 5 billion today. And they said that venture impact investing has grown 50% year on year. So these are ventures that tackle social issues like preventing mental health issues, childhood obesity, and the aging population. So I want to ask you, are you seeing that? That sounds quite extraordinary, 50% year-on-year growth in venture. Are you seeing that kind of growth? Jean, are you seeing that?
Yes, absolutely. We're seeing a number of things. We're seeing this next generation of entrepreneurs. Many of them, want to build scalable businesses, tech businesses or other businesses, but they want to do that with an impact. And therefore, the quality of founders and business ideas that are coming out has grown kind of exponentially in the last few years. And therefore, the money is kind of moving into that. I think technology is also kind of graduated now kind of things like Amazon and eBay. You can get an e-commerce product from X to Y, and you can do this and that with technology. And I think people are now thinking, okay, well, what else can you do to make the planet a better place for people to live in and for the environment? So I think the kind of conversations changed a bit from the founders, and the money's kind of chasing that talent.
Yeah.
Okay.
The only thing I was going to add is that I think that the first time we interacted with Big Society Capital was when we launched Wire Unlimited. And what we saw there was that both government and charities were thinking about whether or not there was a more efficient way to solve social problems rather than relying on government or relying on charities. Could you actually use some of that money that governments and charities have that, let's be honest, isn't always used efficiently, and invest them in startups that can think about scalable ways or scalable solutions to societal problems? And so I think that might be kind of like what's the engine behind this as well, because if we look to the Fair by Design Fund, it's basically Big Society Capital saying, hey, this is a real problem, but we as a charity aren't really going to come up with the solutions. Can we put 10 million or whatever it is aside and essentially empower founders to kind of create these solutions at scale? So I think that may be part of what's happening as well. The money is saying that the current solutions to solving social problems has proved to be ineffective and inefficient, and maybe empowering entrepreneurs might be more effective.
Jamie, I actually just wanted to come back to one of your points at the start, was around the description of venture capital. And Foresight, we have quite a large private equity team, and then we sit within a subset as a venture capital fund. one of the observations I've made is, whilst it's easy to think that they are sort of one and the same, albeit looking at different stage, the way I'd almost categorize it, I think as a VC investor, you're looking to try and be on the same side of the table as the entrepreneurs and founders. You're fundamentally backing great people who you can believe can do wonderful things with your money. I see sort of private equity as a little bit more, they're looking at a underlying successful business that they think they can make more successful. And that might often involve having some new management team come in. So actually for me, there's a slight kind of difference in mindset between backing the founders and backing those great people and then backing the underlying business opportunity. But in terms of what we've seen, I mean, our Foresight Williams fund is a retail fund. So ours is private capital from investors under the EIS and VCT rules. So looking for tax efficiencies. Certainly pre-COVID, we were seeing a lot of money coming into the fund. Since COVID, it's slowed down a bit, but there's no doubt that there's a lot of appetite for investing in early stage businesses as people realize that it's a really vibrant part of the UK economy.
So let me ask you guys about COVID and what's COVID done to the pace of funding? I mean, generally speaking, my impression is that the pace of funding has slowed because of COVID. Is that a temporary thing? Is that a blip, or does it just heighten everybody's awareness of some of the options for private capital in these spaces? What do you think?
We've certainly found it harder to get deals done. As I said, you're backing people, so invariably you need to spend time with them, and spending a few sessions with them in a room together, you quickly get a feeling for whether you can work with them for several years to come. So we've done a few deals in a sort of wholly virtual world, but it has taken longer. I think one of the challenges we've seen is that you've got companies who are still coming to market with kind of pre-COVID valuation expectations. And then you sit with them and you walk through their pipeline of commercial opportunities, and you see that, over half of them have been delayed or postponed because of COVID. And you sort of realize, well, hang on, your potential for future growth is now much slower. And as an investor, you don't really want a team who sat there kind of twiddling their thumbs, waiting for those commercial opportunities to come in. So there's a bit of a kind of valuation realignment, which I think needs to go on. And obviously some founders are more open to that than others, depending on their current financing situation.
Yeah.
So just to put a little bit of controversy in this and kind of
go ahead,
founder side, I would say that what you're seeing is that like a lot of investors are more risk averse. They're kind of doubling down on the safer bets within their portfolios. So the winners within their portfolios, they aren't really seeming to want to take bets. I mean, I think Europe is basically risk averse anyway. And I think that now that you have COVID, it's like risk averse squared, whatever that is. So it's basically like early stage startups aren't really seeing that much love from investors. And people are saying that funds are basically doubling down on the winners within their portfolios. And then you are seeing some of this behavior where people are saying, well, now actually we do have some leverage over the founders. So let's actually figure out how we can kind of reevaluate the valuations because they have fewer options for funding. Not to say that that isn't always justified by the realities of the market, but sometimes it's just pure opportunism. So it's kind of like, yeah, that's what I would say. As a founder, it's definitely a lot more difficult. And yeah, like I, as an American founder, I'm like, why am I here? Like, I feel like there's much more money in America. Like, and here, it's like there was never that much money to begin with. And now it seems like there's even less.
That was one of my questions, Gary, but we can get back to that. The real question I really want to major with is what constitutes impact in the venture space? So you've got venture and you've got impact. So if venture capital is funding startups that are solving problems that matter, if that's a definition you guys would accept, then what is the difference between venture and impact? Is it the founders and who you're funding? Is it the impact delivery and measurement? Is it the sector you invest in? Is it the people that are impacted by the products and services? I mean, what would you say? So what makes for impact in a venture context?
Well, I mean, I think the company structure is kind of the first bit. So you're either a company that has kind of shares and equity, and therefore you can sell that equity to a venture fund or to an angel, and they own a piece of your company. And then you've got a lot of impact investing is happening kind of where you're investing into a charity or a kick, and therefore you can only kind of lend that money with an interest rate. So I think impact kind of splits immediately down those two corridors in terms of what the underlying company structure is. And then if you're a charity or kick, then I think your whole mission is impact. And then it becomes more blurred when you're in the kind of tech for good space where, ed tech by definition, if you're educating people or promoting education using technology is impact. And then other impact businesses in the tech space are more blurred, let's say. But I think the first bit is it kind of equity or is it a loan into those businesses, is how we break it down initially.
And a kick, Sean, is a community interest company?
Yeah. So our Fair by Design fund, for example, we've got the freedom to either invest in shares with, equity, or we can loan money to a kick or a charity, but then you have to charge interest. Obviously, if you're lending money to somebody with a 5 or 8% interest rate, there's limited upside. Whereas if you're doing an equity investment and that business scales, but those are the two kind of vehicles that you can invest in.
And Chris, so how do you know whether you're investing in impact or not?
Yeah, I guess we look at it as a spectrum. So I think at one end you've got purely financial business, then you've got companies who are doing something responsible, so perhaps not directly harming the planet. I think the next step along is more around sustainable businesses who are perhaps looking to improve their footprint on the planet. We then, I think, get into the kind of the impact zone, which is kind of addressing societal challenges. And I think within that, you've then got those which have varying degrees of kind of potential for return. So some are, fantastic impact, but unlikely to ever really generate a return on capital, all the way through to really great commercial businesses with a fantastic impact. And then at the far extreme, it's sort of real impact only, which I sort of feel you're starting to blend in towards the sort of the charity end of the spectrum. For me, I got most comfortable looking at really solid commercial opportunities, which had a fantastic impact in what they were doing. And some of those businesses, they appreciated and understood and majored on the impact. And others, they didn't really realize the impact that they could have. And I think one of the joys in impact investing is working with those entrepreneurs to help realize that they can do much more than just a single bottom line profitability.
But your focus, Chris, is on making sure that the company is financially sound. That's where you focus. And then...
I think my findings from the companies that we've invested in is, unfortunately, you have to have a commercially successful business to have sustainable impact.
Yeah. Gary, you and I had a conversation a couple months ago, an interesting conversation about impact and how you define impact. Let me hear from you on this. What makes for impact, and is it even the right label?
Yeah, no, so I kind of like listening to the dichotomies. I'm like, it should be possible to like walk and chew gum at the same time. Like you can do good and do well. Like it doesn't have to be this kind of like, contradiction. And I think that historically it has felt that way, where it's like, okay, so if I have a commercial or profit motive, then I'm anti-impact. I'm a bad person because you almost have to be entirely like philanthropic or charitable in order to be impact. And so even companies that are doing good things in society aren't recognized because they also want to make money. I think that for me, it's like, can we do good and do well? Like that's what I want to do as a founder. And I think we should be moving towards that alignment where we're moving away from companies that are actively harming society. And then saying we're going to kind of compensate that by companies that are actively doing well in society, but without making money. Like, I think everyone should be trying to do something that solves a real societal problem. And the thing is, if you're solving a real societal problem, that means that there's probably a really large market for it. And as long as you can figure out what the business model is, you can make a lot of money. And I don't understand why that has to be contradictory. So for my business, I really actively avoid the term impact because I think even listening to this conversation, people use it as a proxy for charity. And I'm definitely not trying to found a charity. I'm trying to solve a problem and make a lot of money. And I don't see the two things as contradictory.
Okay.
Yeah, I agree. It's profit and purpose, isn't it?
So Gary, let me just mention the Impact America Fund, which just closed a $55 million fund this week. It's managed by a woman named Keisha Cash. So this is one of the largest ever closings by a Black female GP. And she says the goal is to invest in companies with an outsized impact on low and moderate income communities. So she defines the impact as the impact on the communities. And then she says that she does focus on the diversity of the founders. That's an important part, but it's not our strategy. So it's really defined, for her, it's defined on what happens to the communities that get served. So does that make sense? Is that consistent with what your thinking is?
Yeah, because the thing is, I think that probably there are a lot of problems in minority communities that maybe the founder of Uber is not going to see. But it doesn't necessarily mean that there's not a large market for it or that money can't be made by solving it, right? And I think that historically what's happened is that you do have in a lot of communities problems that people are solving in a very entrepreneurial way. It's just that these aren't the types of companies that then get financed either by impact investors or by traditional venture capitalists and angels. So they only become like these mom and pop operations. And I guess that what this fund can do is to say some of those opportunities actually deserve to be scaled, and here's some money to scale them. And the impact is going to be that if you look at the US right now, I mean, even if she's not actively focusing on diversity, all of the protests that are happening are because there's been kind of systemic oppression of certain segments of the population. Empowering those folks to be able to solve their own problems and to make their own money and to be able to then transfer that money across generations would mean that a lot of problems that right now need to be solved by government in the forms of benefits and things like that can now be solved by communities empowered by investors. And so that is social impact. It's removing kind of the need for government to solve problems or philanthropy to solve problems and empowering the beneficiaries themselves to identify and solve their own problems and make money in the process.
Just to be clear, she says that 70% of her companies are Black-led. So she's, it's not the focus, but she seems to do a really good job. And Jean, let me ask you, so one of the reasons I bring up the Impact America Fund is that it's the funders came, I mean, it was MacArthur Foundation, Ford, California Wellness, Kellogg Foundation, and then some clients of large wealth managers, which leads me to ask that's kind of a concessionary. Those aren't capitalists. Those are people who are with social missions. Does that mean, I don't know, does that mean that you can't make money in this space? Is it really, is impact pointed at people who are willing to make a concession?
I mean, we have a similar fund, our Fair by Design fund, looking at reducing poverty in the UK. So, and specifically the poverty premium, this is this notion that low-income households pay more for the same goods and services that people that are better off across higher costs of energy, access to credit. And that fund that we've been running for 3 years currently has got a 20% net IRR. So it's the businesses that we've backed, a lot of them are in the fintech space or energy space. So although they're doing good for society, they're performing well, and our co-investors are not impact. So this is an example of something that's kind of doing good for that kind of low income, vulnerable part of the population. And there is no discernible kind of lack of returns or any compromise on returns because we're backing scalable businesses that are mass market by definition, because they need to also touch the people that can least afford these services. So it's kind of an interesting model for the industry.
So if you're saying if you go after an underserved population, then that's a big market because there are a lot of underserved people, right? And is that the...
Yes.
Yeah.
Well, yes, and if you're serving the underserved, you can also serve the rest of the population as well. But yeah, so the poverty premium itself is a £3.8 billion annual cost that low-income households kind of are paying more than the rest of the population. So there's a kind of big market there, and technology can rework how these business models are created, and lower cost base allows you to kind of pass on some of those savings to the population.
So, John, may I ask? I'd be interested. Those companies that you see have a really good scalable business model. Do you actively encourage them to target perhaps some of those underserved or people more vulnerable to the poverty premium if it wasn't in their kind of core business plan? Do you work with them to kind of deliver more impact than they were potentially planning on doing without your involvement?
Absolutely, yes. So some of them aren't even aware that their products are tackling the poverty premium. For example, WageStream, which is a business that raised a Series B, led by Bolton Capital, and they help with income streaming. And when we met them, the whole poverty premium and access to credit was kind of not really what they were thinking. So we've really kind of moved them in that direction. Other businesses that are reducing your energy costs or helping community banks to compete with payday lenders, by definition, they were impact in their product and in their kind of inception. But other ones, yes, we do guide in that direction, which is great. And then we bring along some of the less impact venture capitalists, alongside with us on the same mission. So that is rewarding.
So let me ask you this then. So I feel like if you take a conventional venture portfolio, not impact, doesn't do any of the things, doesn't self-identify as impact, doesn't label as impact, it just does what venture funds do, find people who are solving problems that people care about and make a lot of money. Aren't you going to find a lot of impactful companies in a conventional venture fund. Isn't that going to?
I would agree. I mean, when I look at our portfolio, we have a company called Open Bionics, which does 3D printed bionic arms, and it enables children with lower limb deformities to have arms as they grow up. And they've done a fantastic branding campaign with Marvel Comics, such that then they're basically turning a disability into a superpower, such that these arms are branded, and all the stigma associated with a lower limb deformity in children is kind of gone away, because it's something that's very cool to have. You know, we're obviously very proud to have them in the portfolio. They're doing fantastically well, but I think we could do so much more to help them truly articulate the value of their impact. And likewise, we have a couple of investments in the energy sector, which are helping customers save energy. So again, fantastic impact, but we could be doing more to really articulate that and help them appreciate the impact they can have.
So again, I'll try to kind of like just take a different point of view. I don't buy this like invisible hand approach. I mean, I think that like if you look at like where Silicon Valley, let's say, which is kind of like the big funder of venture capital, has invested, it's usually been in the sorts of products and services that are relevant to people in Silicon Valley. And those problems aren't necessarily the ones that are affecting 99% of the population. So I do think that it does require a little bit of intentionality to kind of have people say, can we focus on problems that we may not have, but that the rest of the population does have? Because obviously, if we look around the world, the fact that people keep getting ignored is, I think, what leads, I'm sorry to get political, to Brexit and Trump. And it means that too many people have been ignoring these problems for too long. So I don't think that it's that like everyone is just saying, oh, there are market opportunities or even political opportunities there. I think usually people operate within a bubble where they only see their own problems and their friends' problems, and they think that that means that that's everyone else's problems as well. And then a lot of other folks are getting ignored. And I think that we do need to diversify then the people who are making the investment decisions, so we can then also have a broader understanding of the potential problems that people are having.
Okay, Gary, so let's drill in on that a little bit, because so why is it that women founders and BAME founders are underrepresented? What is going on? What is the solution?
Yeah, I think that, you know, it's just the way that kind of like funds are structured. It's usually like 4 or 5 people who were friends before and kind of came from the same, you know, networks, or kind of, and it's a very kind of like close-knit group. And so they kind of see people who are not necessarily like them to be a risk, you know, because when I talk to investors, I'm like, so I don't understand, like you can't find, even if you're being like very snobbish, you can't find a Black person or a brown person or a woman that went to Harvard, Stanford, worked at McKinsey, Goldman Sachs. I mean, come on, there are enough people that have like really stellar academic and professional credentials. For you to just have one person seems really difficult to believe. There's no pipeline. And I think a lot of it's just comfort, that people just say, well, you know, I hire people that I know or that come from my network, and I hire people that I feel comfortable with, and they're only going to be like 4 or 5 of us, my partners, and I'm not really going to take a risk for this diversity thing. And they think the diversity thing is like charity. So it's like, if I do it, I'll do it, but it's going to be like charitable, not necessarily that I'm actually going to give decision-making authority to that person to write a check. And I think as long as that's the case, then you have this kind of like very homogenous system that just feeds upon itself. And then the people who are then making these decisions, if you look in the US again, I think that there was a study that said of the top 100 funds in the US, there were only 7 Black people with decision-making power, right? So Black people in the US, by and large, even being 14% of the population, are not represented in funds. So for that to change, someone has to make an active choice to diversify. And I think right now, in these very small networks that are kind of not really being in, they don't have to kind of give public disclosure, because that's the other thing. When you say to funds, are you willing to just tell us like the diversity of your teams or the diversity of your portfolios? You get a lot of pushback. So right now there is no light being shined on them or shown on them. So I think that's kind of the problem. These are very insular, familiar networks, and people don't want to diversify them.
So what's the solution then?
Solution is that people need to have targets. They need to kind of be held accountable publicly by their limited partners. So going back to the example that you gave of, you know, the MacArthur Foundation, the Ford Foundation, in the same way that everyone is talking about ESG, or like what Yale did the other day, saying to their, you know, to their investors or whatever, if you want our money, you're going to have to kind of give us some diversity statistics because this matters to us. I think that's the way to get people to change. If they are not going to get funded unless they kind of start to focus on broader societal challenges, then they will make those changes. If it's up to them, if it's just an optionality or a choice, then it will never change.
And Jean, what about Ascension and Fair by Design? What are you doing on the issue of diverse founders?
Diverse founders. There's quite a bit of movement in the VC world of female office hours and kind of different office hours that a bunch of different early stage venture capitalists are getting together to try and promote deal flow and trying to reach out to different audiences. So it's not easy, particularly with kind of lockdown, but there are a lot of virtual events where we're kind of opening up to diversity and trying to reach out to other groups. Because yeah, I think Gary's right. To start a venture capital company, basically people either are exited entrepreneurs or they've come from like large VC in the first place. So if there's starting a VC, you need to be able to raise money, you need to have a balance sheet, you need to have contacts. So generally you come from those two areas. And if those two areas are underrepresented, then by definition, the people setting up new ventures will be underrepresented. I mean, Ada Ventures have got an interesting model where they are reaching out to communities that are different from theirs and getting venture scouts in those communities that they're incentivizing to bring them deal flow. So a lot of my deal flow comes from my network, and that could be people I've worked with from the kind of my tech media background, or people I've gone to university with, or whatever. So I think what Ada's done is interesting. They're kind of moving out to different communities. But yes, the other thing we're doing is anything that comes in that looks like from a different background or a female founder, like we'll do more than just look at the deck and reject. Like we're actually positively trying to spend more time if something's come from a different source than is usual to us, which is not necessarily fair to other people, but it's kind of, we're trying to get a balanced portfolio here, and it's a challenge.
Let me ask you about the corporate sponsored venture. So Gary, Telefonica, Chris at Centrica, do they have more flexibility to try to shape the funding, shape the diversity of the funding? I mean, are there more options there just because they've got this corporate umbrella, Chris?
I think so. With Centrica, because we were an impact fund in the energy space, a kind of seed stage or pre-seed, by the time you kind of applied those criteria to it, actually the pool of companies that we were looking at to invest in wasn't that high. I think we certainly did a fantastic job of female founders. I can't quite remember the percentage, but it was a good, not half, but probably 30-40% had female founders. I personally feel that we are absolutely founder agnostic. From my perspective, I'm looking at the quality of the fantastic business that I'm trying to invest in. Where we're investing now, because we're looking at deep technology companies with a lot of university spin-outs, unfortunately, the sort of ethnic background diversity pool isn't there in the ecosystem where these founders are starting, which is challenging. And just going back to the previous point around why is there not more money going to BAME and female founders, I can't disagree with anything that Gary says. I mean, it is an embarrassing, really, at the VC ecosystem that it is a bit, it's too kind of male, privileged middle class. I think the only challenge I have is, when you're investing in an early stage company and in a portfolio of 10, 6 or so could fail, you've got market risk, technology risk from competitors. You're also taking a huge bet on the team. And I think I'm ashamed to say that in the same way that people tend to employ people who are from a similar background and look and feel like them, you sort of invert, not intentionally, but you tend to end up wanting to put your money in people that you can have a close connection with quickly. And if they come from a very different background, it's very hard to build that deep connection over just a few meetings. And even more so now when we're doing it online. So I'm acutely aware that I'm part of the problem. I'm acutely trying to avoid myself succumbing to those biases, but I think it is, and we do need to do more to break the stereotypes and the preconceptions that people in the VC industry are guilty of.
So Gary, one of the reasons I ask, let me just stick this in quickly. One of the reasons I ask about Telefonica and corporate VC is that corporates have started to get religion on breaking out of some of their normal hiring patterns, their normal networks, the notion that it's got to be cultural fit, all of which favors the existing incumbent networks. Question to you more generally, a general question to you, but with respect to Telefonica, do you find that a corporate corporate sponsored venture bring some of that proactivity there, or do they have the same problem as everybody else?
Yeah, I think everyone has the same problems. I mean, I think it's in banking, it's in Hollywood, it's in fashion. I mean, it's not really something that's limited to venture. It's more of a societal problem. And I think that, Chris, actually, I think you really nailed the problem, right? Which is that it's not that there's more talent in certain communities, it's that there's more comfort with certain founders, right? So I've seen it, and Jean, you've been on enough investment committees with me. We can start where we get to the final panel, and there are 10 candidates, 50% women, and maybe like 3 minorities. And it will always end up that the white guys are the ones that get the benefit of the doubt, right? Because there's a kind of comfort level. So I've also seen it. Like, it's not about, and the other thing I kind of want to, kind of burst a little bit is like this notion that venture capitalists have like this unique ability to detect success stories when 95% of venture capitalists will never make the money back. So the idea being that they've somehow identified successfully a pattern and they're replicating this pattern in a risk-averse way is fallacious because they haven't identified the pattern. Most of them do not make money. It's only the top 5% of VCs, Sequoia, Andreessen Horowitz Index, that will ever make any money. Everyone else will fail. So maybe it's time to try something that you didn't try before. Going with people that you are comfortable with doesn't work, right? Going with markets that you think you understand doesn't work. So there's really no reason then to say, okay, well, I need, the model that I'm using right now works. Actually, it doesn't work for 95% of the population. And I think, or the investor, the VC population. And I think to the question about whether corporates are better, I think this kind of goes back to what I would say to Jean as well. There's a lot of kind of like, what's I'm looking for, like window dressing, right? Where it's like, okay, let's do office hours, let's do mentorship. What I'm really interested in is what's the percentage of companies that are from underprivileged backgrounds or underrepresented backgrounds that end up getting the check? Because there's certainly a lot of efforts, especially at the non-partner level with office hours. So getting kind of like hiring more female associates and then getting those female associates to kind of do female office hours, but those female associates can't sign a check and those female associates don't end up investing in startups. So there's a lot of talk, but I want to see the money invested in underrepresented folks, especially when, going back to the numbers I gave before, 70% of the people in America are women and minorities. It's kind of crazy that only 3% of them are get funded.
Okay, although this topic would be worth another hour and a half of discussion, I do want to switch to the more eclectic selection of questions that we're getting from the audience. So if I could just do that, if you don't mind. So question, to what extent are we seeing VCs invest in emerging markets? And how are VCs linking with governments and donors to tackle contextual needs? Any takers on that?
Yeah, I could do that. I mean, because one of the things that we did with Wire, and we saw the British government trying to do a lot of work in promoting in a Brexit world, this notion that the UK was somehow like very good in terms of entrepreneurship, which I guess relative to a lot of other places it is. But I don't think that what you're seeing right now is either corporates or investors saying they're willing to invest in these emerging markets. I think that you're seeing like some funds, like maybe a Sequoia or a few other ones kind of reaching out, but most of them aren't really even investing in the UK, much less in Paris or in Germany. So I think that you're not really seeing like a lot of funds kind of go beyond their own kind of geographical limits. Yeah, and that's what I would say. Definitely not in kind of emerging markets for the moment. I think I saw a statistic saying that 60% of all venture occurs in 10 cities in the world. 8 of them are in China and the US, and the only 2 that are outside of that would be London and Bangalore.
Yeah. John, I have a question for you, I think. Or, I mean, everybody can comment, but starting with you, impacts-driven founders often steer clear of VC because they fear losing control to investors who will compromise the ethical values of the mission. So they typically bootstrap, or they found a kick, as you mentioned. Are there other ways to safeguard mission for a VC-backed impact startup through the inevitable dilution?
Well, I think it depends what the business is. A lot of businesses that we invest in are kind of lockstep, like an ed tech business. If it scales, it's educating more people or something around. We do a lot of e-commerce, sustainable e-commerce businesses. So a lot of impact businesses are by definition kind of linked to their commercial success, increases their impact. In the case where that's not the case, you can find impact investors to back you. You can put things into your articles of association to protect your mission if you're afraid of that. But certainly, you shouldn't be taking any money from from an investor, whether that's an angel or venture capitalist, that doesn't buy into your mission and doesn't get your vision. That's for sure. And it's like a marriage, so you shouldn't be taking money from somebody that doesn't share what you're trying to achieve.
But what about the next stage? So when you, as a venture investor, you hand it off to the next guys, you hand it off to the, you go through seed A and B and C, and then you can go into private equity and then eventually an IPO. As you hand the company off, how do you maintain the mission and purpose of that company as you progress through the capital hierarchy?
Well, again, I mean, if that's the most important thing to you, and the mission is not necessarily linked to the success of your business, then you can only sell to people that you believe share your mission and your vision. And if you still control that process as a founder, don't sell to anybody that you feel isn't going to maintain that mission. I don't know, Chris or Gary, if you have anything to add to that.
I don't have answers, only just to sort of completely agree with the challenge. I mean, I guess, again, you can sort of go down the sort of B Corp accreditation route and sort of, rubber stamp yourself as an impact focused business, or align yourself with directors or an executive board who have a strong impact and hold you true to your mission. So I think there are ways of doing it, but I agree that as the funding rounds move on and the shape of the cap table changes, retaining your core DNA is certainly challenging.
But is it within the control of the founder? Gary, would you say the founder has that, or does it sort of do events and the dynamics of capital raising then take over eventually?
Yeah, no, so I was thinking about like some of the founders that we've been interviewing for the Nest, and I think a lot of them say that they are mission driven, but as bigger investors come in, they just have to kind of remove those from the conversations that they have with investors, but they know that that's still kind of like what's motivating them. So I think it's kind of like you almost have to become bilingual, and you have to speak the language of like the investor, which is I could care less about the mission. I just need to know how I'm going to get a huge return so I can pay back my investors. But then the founder still has the motivation that's driving him or her. And I think that if the founder is doing it for that reason, then it's almost like the money is incidental. So yeah, I would think that good founders, as they kind of raise capital, they need to just learn to speak different languages to different parties.
Okay. I have a question on how do you balance social good versus ROI when looking at impact investing? And there's an add-on to that about exit strategy. Is exit strategy as important as with a non-sustainable investment? But let me just start with the balancing between social good and ROI. And I'm thinking for just through the conversation we've just had, I think I can probably tell what each of you are going to say, but go ahead, what the hell?
No, I mean, for our Fair by Design fund, we would take more risk in a venture if we felt the impact to the mission of reducing the poverty premium was greater. So we have generalist tech funds where we don't have an impact kind of mission. We will invest in those portfolios. You will have some tech for good businesses, but certainly in our Fair by Design and Good Food Fund, the greater the impact, the more risk we're willing to take, i.e. possibly lower returns, because we're kind of out there taking a risk and trying to scale a business that's got big impact. So there is, in our impact funds, we do have some compromise in terms of we're taking more risk if the impact's higher, for sure.
Okay, and Chris, you've already opined on this, right?
I mean, I guess they're both difficult to quantify. Impact is very hard to measure, to put into numbers, and then to be able to compare to ROI. And any guess about ROI of an investment on the way in is just that, is a sort of pure guess. So I guess you are dealing in incredibly intangible, opaque concepts. I think the one thing that we did at Centrica was we worked with a impact consultant on a theory of change model, which allowed us to sort of understand the kind of activities, outputs, outcomes, and impacts that business does. And that was a requirement for our investment process. And then we held that company to account. So I think by the time we'd gone through that process, we started to have a good feeling for the kind of level of impact that company could have. But I certainly don't think on the way in that you can ever sort of categorically say, one doesn't match the other, or they're just too hard to measure, I think.
And Gary, I'm going to guess you're going to stick to your walk and chew gum position.
Yeah, no, I was gonna say, because when we had Wire Unlimited, the big challenge was a lot of impact startups almost felt like they didn't have to think about a business model. And I think that that was kind of, it meant that they had no impact and no business. So I think that it's kind of like, yeah, you do need to have founders that are thinking about how do they make sure that they're around in 10 years. And then afterwards, they can kind of figure out like how they want to divvy up, the money. But I think the initial thing has to really be about how do we make sure this is a business? And then we figure out like how we kind of deal with the returns.
Okay. I mean, there's a question in here about, this is quite an involved question, on impact reporting. And so I'm going to try to digest it. But the point is that one of the mega trends in ESG and impact space is the increasing convergence and adoption of common impact measurement, management, and reporting standards, even though this is still a work in progress. But it seems that these standards seem to be developed with larger and more mature firms in mind, if only from a resourcing perspective. So the question is, you've got this infrastructure, this interest in impact measurement, management, reporting. It's mostly built for large firms. When you plop the manual on the desk of a founder, what happens?
Well, I mean, again, going back to our Fair by Design fund, we're relatively lucky in the sense that Bristol University did a study on the poverty premium, this notion that low-income households pay more, and that was 20% of the population spending £490 more than people that were better off. So our impact report measures each of our portfolio companies, how many households they've touched and what savings they've made in that year. So our objective for the fund is to basically eradicate the poverty premium. So we have a very monetary impact, which I think, we're relatively lucky because we've got a target to reduce. With our Good Food Fund, tackling childhood obesity, we're looking at the reduction of calories in and how many children the products that we invest in, will be reaching. So they're kind of almost like monetary or numbers that you can track, which is kind of, I guess, nice to some extent, rather than somebody having an opinion about it.
So you're saying, Jean, that it's not been a burden because the kind of metrics that people are looking at for the impact are pretty straightforward and connected to the business and what it's actually doing. Is that what you're saying?
Yeah, that's what I'm saying as well. And it's easier for us to measure than possibly other impact investments or funds. And we basically ask our portfolio to measure that with our help twice a year. So we hope that it's not too cumbersome for them.
I think one of the challenges we had was when you look at about breadth of impact, then depth of impact. And so you could get really fantastic numbers if you look at kind of breadth of impact. And if we had a company that BioBean, they did the coffee waste fuel briquettes from waste coffee grounds. And so they sold tens of thousands of bags. And you could obviously look at a large number and said that, that's the breadth of impact. But then you realize they're often kind of middle-class individuals buying these coffee logs to burn on their chiminea. It's kind of slightly different to some of the other companies which had, took on 3 or 4 NEETs and trained them up in some fundamental skills, which then allowed them to go on and, have a more fruitful career. So for there, we're kind of really looking at depth of impact. And it was always trying to being able to articulate those two parameters or dimensions, but then applying it to quite a large portfolio of different companies that did different things in different ways. So I don't think we ever really truly cracked being able to articulate impact across a diverse portfolio in a sort of coherent and clean way.
Gary, what's your view? Do you see it as a burden for the founders? Is this just like another bit of, that we barely keep our heads above water, lots of us fail, and now you're asking me to fill out forms that go through, umpteen different categories. Is that doable? Does there need to be a simplified version for startups that isn't the same as, the UNDP standards for private equity? Surely that should not be required of a startup. But what's your view on that?
Yeah, no, my view is that it should be somehow naturally tied to the KPIs that determine the success or failure of the business, right? Okay. And that they shouldn't be these kind of artificial, because I think that sometimes, especially when it's tied up to government money, it's almost like then you have to kind of do these things that government can then use to do reports and stuff like that. But a startup isn't there to do government reports. So I would say if it's something that's kind of natural to the way the founder has to think about his or her business in order for success to occur, then that's okay. If it's something that is kind of this bureaucratic obligation in order to access funding, then I think that's probably legitimate.
Okay, all right. A question, how did the panel feel about funding investment, hang on, just lost it. Oh, funding investment for organizations that step into a profitable market and choose to divert profits to impact organizations, having repaid investor returns first. So I think that describes, I think if I'm understanding this correctly, a conventional business that then pays its investors and then diverts profits to support a social organization of some description. What's your view on that? Any opinion?
As long as the board and the investors are on board, I guess it's fine, because they're the ones that ultimately have to approve it.
Yeah, I think I'd agree with that. So no issue with it.
Yeah, we've invested in a few companies where they're giving 10% of their profits to charity. You know, at the point when we invest, the founder makes that clear that that's part of their mission, and we invested in that. So we don't have an issue with that.
You don't have an issue with it, but it's not, for example, it's not embedded in the business. I mean, Gary, you were saying you want this to be embedded in the business. That's kind of an add-on. So if you, if you run a conventional coffee shop and then donate X% of your profits, I'm trying to remember, is it Tom's Shoes that does that, or but maybe that's related to their shoes, and so it is relevant. But I mean, if you run a conventional business and then donate a percentage of your profits, that feels different from a business that's built around solving a problem that has social and environmental impact. But
yeah, because I think that maybe some of those businesses are using it as a marketing technique. So they're using marketing budget. This is customer acquisition cost.
Yep.
And so, yeah, it depends on like what's the real purpose. I would say that I would still prefer a company that's solving a real social problem in a way that's also profitable. That's how I would want to see the world evolve.
Yep. Okay. Let me ask what may be the final question. So many of the ventures with highest social impact are quite country specific, or at least harder to scale globally because they rely on country specific knowledge, for example, local legal custom. But VCs only seem interested in global concepts. Why is that? And is there a fundamental mismatch here?
I don't see any mismatch in terms of the businesses that we invest in. All of them are scalable. All of them have global potential, and every business, whether you're impact or not, you've got, markets, peculiarities, consumer behavior is different, language. So I think some impact charities are very local, and maybe that's what is being referred to, and maybe those are more difficult to scale. I'm not sure, but I don't see that in a kind of technology for good business.
Yeah, I think that the issue is that like a lot of founders that come from smaller markets, they aren't ambitious enough with how far they think it can go. And so they're just happy if you're like in, Nigeria or even Birmingham to kind of solve a very local problem. I think that where venture comes in is to say, okay, that's a really great insight. How do we scale this so we make lots of money together? And I think that that's simply an issue of kind of just helping founders to be more ambitious.
I just want to make an editorial comment on this interest in scale and making lots of money, because a venture investor has to make a lot of money on some of the companies because he knows perfectly well that some of them are going to go bust. So although on average the returns are meant to be quite high, the fact is you have to focus on companies that make a lot of money, because some of them are going to make no money at all. You're going to lose your money. I'm not sure people kind of have a full appreciation of what the portfolio approach to this is. I need to ask my own personal question, which has been bothering me for a long time. Why isn't there, so we have SEIS for startups, we have EIS for startups, but how come there isn't a VCT fund, VCT impact venture fund? Why, what are we missing here?
It's a great question, and I don't see why there shouldn't be. I mean, I think a lot of people who do put money into EIS and VCT funds are doing it primarily for the tax relief and from a tax planning perspective. The Foresight Williams Technology Fund is doing very well because we have an angle and an edge and an interesting narrative in the fact that we're investing in advanced engineering companies, and it's a great partnership. So it helps us to differentiate ourselves from some of the more generic funds out there. So I think there's a fantastic opportunity out there for an impact-led VCT or EIS fund, which targets the money for those who are looking, fortunate enough to be in a position to need to tax plan with these types of products, but also have a desire to have some impact with that money.
Well, but I can get SEIS on an individual company, but if I want a diversified company where somebody else is selecting them and it's still in that same area, but it's highly diversified, I mean, that would typically be something like a VCT, but I just don't see any. But when you throw in 30% tax relief, which looks a little bit like a 45% return for a higher rate taxpayer, that takes away a lot of the reservations about the risk, including in a social impact environment. It's just surprising to me that there isn't one, but I imagine somebody will get there eventually.
I think just one of the other challenges is that quite often, in a undifferentiated market, the main differentiator to choose which VCT to go into is your historic returns profile. So if you make the assumption or belief that potentially impact funds struggle to meet the returns profile of a conventional fund, and I think that's open for debate. It might be challenging. So a new product, I'm sure, would earn money. Whether it has then the ability to last in perpetuity relies on its ultimate success.
Yeah. All right. Well,
I mean, I think Triple Point has an impact EIS fund. I don't know about impact VCT funds, but certainly there's some impact EIS funds out there.
Okay. Well, unfortunately, we've run out of time, and on a topic that I personally could spend another couple hours with you guys on, which so I'm hoping. So we've left some questions on the table. I hope we can pick up some of the questions outstanding and maybe revert back to this audience with some selected responses. Before we close, I'd like to ask Chris, Jean, and Gary if they have a final observation to make. A very vibrant conversation, a final pithy bit of wisdom from three guys who know their stuff.
Yeah, I mean, I'm happy to kick off. I mean, it's been a fantastic panel, and thanks for the great conversation. I think for me, that my observation is that a lot more people have a desire to be involved in impactful business than perhaps we give people credit for. And I've really enjoyed working with founders and helping them realize the true impact of their ventures. And so I think it's sometimes we get a bit confused that people have to go in with the desire for impact, but I think there's so much more potential out there if you help people unlock it. And there's a lot to be done in the venture community for being supportive and encouraging investors to look beyond just financial returns.
Okay, Jean?
Well, I mean, I think this COVID lockdown has been a pretty horrible thing for the world, but I do believe that coming out of it, a lot more founders seem to be impact focused. There's a lot more money coming into the space. So I think, if you're going to work in tech and you're going to, either work as a founder or as an investor, why not work or invest in stuff that makes the world a better place? And I think that trend is going to accelerate dramatically in the coming decade, luckily, and, good for the planet and people.
Great. Thanks for that. Gary?
Yeah, no, something similar. I think that Brexit, Trump, and COVID 2020 has shown that there are a lot of real problems out there that a lot of people are suffering. And I think that brilliant entrepreneurs should be trying to solve those problems. And it doesn't make a difference whether you call them impact or you just call them entrepreneurs. We should be supporting them with our money and with everything else, all of our support. So yeah, that's what I would say.
Fantastic. Thank you very much, Gary, Chris, and Jean, for your thoughts on one of the most exciting areas of investing. And thank you to the audience for taking part today, as well as some fantastic questions and challenges, both from panelists and from audience. So we'd like to the audience, I'd like to say we'd like to stay in touch with you after this discussion. So we'll be sending you a follow-up email with a link to a recording of the webinar. And then maybe we can address some of the questions that didn't get any airtime. So please stay tuned. Thank you for joining us. Stay tuned for future webinars from the Impact Investing Institute. And meanwhile, goodbye and stay safe. Thanks, everybody.
Thanks. Bye-bye.
Thank you. Thanks very much.